First and foremost, that it's not a starting of a process as far as we are concerned. This quarter represents the peaking of a BB and below book, and from here we just see it going in one direction, which is down. Okay, so we see actually a fairly material contraction in our BB and below book in the upcoming quarters. When you say that the other banks went through situations like these, I think the distinction that you need to make is that for many of them it was a cyclical issue, and the resolution cannot happen till the time that the cycle reverses. For us, I don't think that's really the issue. If you look at our BB and below book, it's not as if it's a very granular book or which is very heavily exposed to a particular sector or a particular industry. This is a handful of concentrated exposures which are facing liquidity issues, not solvency issues, and so the reversal of this could also happen very quickly. So we feel that each of the resolutions when they happen, and I expect at least 2 of the larger resolutions to happen this quarter, you will see a fairly big contraction in our BB and below book.
So the problem you're saying is not that you focused on certain sectors like infrastructure, which other banks did, but then maybe the mistake was on certain groups, and I think we do know that there are at least a couple of large groups in your portfolio which at a group level, promoter level, are facing stress. How easy will that be to resolve?
So I think it's in hindsight you can always say it was a mistake or it was poor judgment, but if you see when these exposures were assumed, and the ratings of these counterparties, I mean, they were absolutely fine. I mean, they were all investment grade and in good health. I think what happened was that post September and what happened with ILFS and then to the NBFC sector, we've seen tightening of credit markets. Refinancing has become tougher, and I think some of these groups have taken the brunt of that. It just so happens that the timing was such that each of them faced this issue with regard to liquidity at the same time, and to that extent. You can start checking in terms of what the underwriting rationale behind this was. I don't quite see it that way. Like I said, it's really a timing issue. But equally, if you see that the underlying assets that these companies have, those are very, very good. And the resolution here does not need to happen in terms of reversal of fortunes of the company per se, which could be a medium long-term event. Here the resolution could happen on the back of asset monetization, it could happen on the basis of a stake sale, it could happen in terms of a change of control or ownership, and I think that's what's effectively happening in many of these names, and so to that extent I don't think this recovery process should be so protracted.
Okay, so the focus now is on the BB and below book, which is about 9% right now?
That's right.
Okay, and you would see it come down to what over what period of time?
Significantly, because if you see the composition of the BB and below book, it actually has very few names. And so each of the names which comes out of it on the back of resolution will actually bring it down significantly. So over the next few quarters, I actually see this book contract very, very significantly.
Okay, but the stress didn't only come from the BB and below, right? I think a couple of these names that we're talking about, these 2 financial services, would have been in the A category, and the A rated is at 41% of your book.
No, so I think, let me just draw that distinction for you. As far as the growth in the BB and below book from 23 to 29,000 crores comes effectively on the back of 2 names, and these are 2 large financial services companies. Here we don't have loans, we have bonds. Or NCDs. So these in any case get a mark to market. So even if you go back to the last quarter and you look at a treasury line, you will see the mark to market on that. So it's not as if these were names which were not known or which have suddenly cropped up. It's just that the level of the mark to market has gone up based on the rating downgrades that these names may have potentially suffered. But the entire slippage for the quarter, if you see, comes from the BB and below book. Okay. Now, the question is that not all of it comes from the watch list that we put out. The reason for putting out a watch list in the last quarter was very, very clear. We were going to be approaching investors for equity, and we looked at names where there were imminent repayments, where we thought that the cash flows could not support those, and we thought it was only right, it was prudent to be able to go out there transparently tell investors that these names could slip. Now, the fact is that the subsequent slippages that may have happened did not only happen from the watch list, but happened from the BB and below book, and at the end of the day the watch list was derived from the BB and below book. So I thought we've got that ring fenced in terms of which were the names where we could potentially face stress. And as far as these 2 financial services names are concerned, yes, I mean the mark to market on those has gone up based on the rating downgrades.
Okay. No, so sorry, correct me if I'm wrong here. So these 2 names would not have been BB and below last quarter, right? In the March quarter.
They weren't.
They were not.
They were not, but they had.
Yeah.
But even though they were investment grade, they had already taken some rating downgrades, and the mark to market for these names was reflecting in our treasury income even last year, even last quarter.
Okay. No, the reason I'm asking that is that one is wondering that from even the A pool, which is very large, which is about 40% of the book, is there an assessment being made by the management that what from that pool has the potential to fall either below investment grade and potentially to a slippage point?
So when we talk about the asset portfolio of Yes Bank, I think one of the things that comes up is the real estate book that we have, which is roughly about 24,000 crores. If you look at the 24,000 crores, 25% of that is fully captured either in the BB and below book or in terms of the NPAs that we have. On the balance 75%, the slippages are absolutely minimal. When I say minimal, they're very small. And then if I look at my overall investment grade corporate book, my SMA2 on the entire thing is about 404 crores. So given how large the asset book is for Yes Bank, and then you look at a number of 404 crores, I think it's really a very, very small marginal number.
And SMA1?
And I think it gives you, SMA1 is more dynamic, so it's more harder to tell, but SMA2, which could potentially point towards potential slippages or incipient weakness, that part is fully captured.